So today we have Fabio Frederici from Base58. Thanks for joining.
Thanks for the invite.
So a quick recap on Fabio. Fabio is the founder and CEO of Base58. It's a technology-driven investment firm specialized in crypto assets. And he has been in the crypto space since 2013. And prior to Base58, he co-founded the first blockchain analytics company in Silicon Valley. The company was part of the acclaimed 500 Startups Accelerator program and subsequently raised a VC round in Silicon Valley before being acquired in 2016. Welcome to the Protos webinar.
Yeah, again, thanks for having me, and hopefully can provide some interesting content.
Very good. So let's kick it off with, you wanted to walk us through what you did in Silicon Valley and the blockchain analytics startup there, and then how you got to Base58. And our favorite is, what do you think about the market going forward? What do you think? Where's Bitcoin gonna go this year?
So essentially, what got me into crypto in the first place. So my original background from college is more on marketing, branding, kind of the business side of things. But I did a lot of data-driven marketing, so social media stuff, mobile, and so on in my studies. And my goal was back then to go into product management, and so I started coding essentially in my free time. And I did one of the Coursera online courses called Startup Engineering, which essentially teaches you how to set up a server, how to deploy an application, all these kind of things. And this course was taught by Balaji Srinivasan, who later went on to found 21 and became CTO at Coinbase for a while. Now he's working on a project called Nakamoto. And so the project was half related to crypto. I mean, the project itself was, okay, how do you build essentially a Kickstarter?
Yeah.
But instead of funding it, let's say, with Stripe or some other credit card payment, we would use Bitcoin. And so he sent out the white paper. I started reading it, and I was very fascinated by it from two perspectives. On one side, obviously, was kind of the more, let's say, fundamental point of having an independent currency and money outside of any kind of government preview. And then the other side was, from a data perspective, the fact that I was used to having very limited access to data at college. A lot of the interesting data is always kind of behind some sort of silo. So the fact that every kind of transaction was publicly available was very fascinating to me. So I started digging deeper there. And then, that's kind of how the idea for Coinalytics came to be. And during my studies, I started spending more and more time actually on this side project rather than on school stuff. And so in February 2014, I decided to go to San Francisco, kind of go to the Mecca of technology, if you want, and understand what do people here think about Bitcoin and the blockchain, and does this technology have a future? And it became very clear that everybody that I met was super smart, super passionate about the topic. And I luckily, I guess, ran into the right people. And we got a spot at the 500 Startups Accelerator program. So I dropped out of my MBA program and then moved to California in 2014. And I mean, what we did is kind of the precursor, if you want, to what companies like Chainalysis or Elliptic are doing today. Obviously, back then, a lot of the infrastructure wasn't there. So what we did is we built indexing engines and query APIs. So we built probably what's still to this day probably one of the most sophisticated API endpoints that allowed you to do kind of a SQL-like query to a REST endpoint. and extract essentially the information that you wanted. So let's say I want all transactions between, let's say, 1 and 2 Bitcoin, or I want blocks that had X amount of Bitcoins transacted. All these kind of questions we're able to answer through an API. And yeah, we then sold the company in end of 2016. From a market perspective, yeah, it was similar. Obviously, 2-year bear market, not that much interest, and the only real way was really to go down the kind of the risk and compliance route, which wasn't really kind of our passion. And so yeah, we decided to kind of sell the company, and then came back to Switzerland, not necessarily to stay here, but to take a break, kind of see what's next. And so yeah, I helped or did some consulting with some of the private banks here in Switzerland that were looking at crypto. Should they look at blockchain data from a, again, risk and compliance perspective? And yeah, through that, I kind of got introduced to some of their wealthier clients, helped them build positions in Bitcoin in early 2017. And then from there, kind of, got pulled more and more into the financial side of the crypto space.
But I mean,
I mean, it became clear very quickly that there was still a lot of opportunity, still a lot of lack of understanding, and people kind of moving too fast, maybe into some assets that, at least in our opinion, weren't necessarily worth it.
Which one? Do you have an example, or?
I mean, it depends on how strict you want to be, right? But I mean, we had calls where people wanted to buy, I don't know, let's say hundreds of thousands of a specific token, but maybe there just was like thousands of dollars traded a day. So it was just a very naive approach to investing in these assets, just purely based on like the price movements, right?
Yeah.
So, the price moved 30%. Let's go buy some of this, right? Without necessarily so knowing like what is it actually that you're buying, what's the liquidity look like, where do we buy it, also how do we get out of it again. So a lot of these questions were unanswered. So that's how kind of Base58 came to be.
Yeah, cool.
And
so I mean, tell us more about. I think about the analytics company. I think that was obviously a big story, right? And it still is in terms of compliance, and I guess a lot of the transactions are being screened today. So I think obviously that was a very good starting point. And but yeah, I think, since you now have moved to Base58, maybe give us a quick background on what you guys are doing at Base58 right now.
Sure. So we have 2 business lines, if you want, so that our primary focus. We have on one side, we provide passive exposure to high net worth individuals, family offices, mainly people who are kind of first time getting exposure to crypto. And so we have one product that essentially tracks Bitcoin, and then we created an index called the Base5 index, which is available on Bloomberg and Reuters, together with a company called Selective in Germany. We take the top 5 crypto assets by market cap. We applied a quality filter where we remove forks, for example, like Bitcoin Cash or BSV, some other fundamental metrics. And we just provide an effective and efficient way for people to get exposure to crypto. But how in a structure that they're familiar with, like I think still today, like it can still be cumbersome or unfamiliar for people to get it. How do we buy crypto? How do we transfer it? How do we secure it? And so we give them like a very easy path, entry point to the asset class.
But I mean, how do you actually buy it then? You buy it through the structured product, or?
So they buy a fund.
Okay, they buy a fund. Okay,
yeah. and then we go buy the underlying, put it in custody.
That's the fund in Malta, I think you guys have, right?
Correct.
Yeah. Okay, so that's one business line, and then yeah,
and then we have the active trading, which currently runs on our own book. Why we built track record and kind of develop some of these strategies. So yeah, we develop fully automated trading systems, trading right now spot and derivatives, so futures and perps or perpetual swaps. And yeah, strategy-wise, it's arbitrage, basis trades, lending. Yeah.
Cool. I mean, let's just briefly go back to, because I think it's interesting that you guys doing a quality screen, right? And I mean, for example, I'm always looking at the Galaxy index, right? Because Galaxy developed the Bloomberg index as well. And when I saw it the first time, I had to kind of laugh because they had a very weird quality screen with like a, you know, some really weird altcoins in it on this at the same time, dropping some of the major positions. And then there was a limit, I think, in the Galaxy index. So how is your index different to the Galaxy one, or let's say a normal market cap weighted index? And why do you think, you know, like quality really is going to make a difference? Because, you know, I'm guessing, yeah, you're thinking that probably has a performance impact, right?
Yeah, I mean, the performance impact we believe is say long term, if you want to. So yeah, as I mentioned, so we remove the let's say minority forks, if you want to. So Bitcoin Cash, BSV. We have what we call like a verifiable from Genesis filter. So that gets rid of things like Ripple, for example, where you actually can't independently go verify the full history of a crypto asset. I think these are like some of the, let's say, fundamental values that we think make actually what a crypto asset is, if you want so. It should have like a decentralized consensus mechanism. And yeah, the last piece, obviously for us important, is where is it traded and is there custody support, right? Because for us, the goal for an index is, okay, how do we kind of minimize the tracking error? So we wanted to include that kind of in the eligibility of the assets that go into the filter.
And what would be like a profit custody for you guys? Like what would be?
So we work with Coinbase custody at the moment. Yeah, for the fund, like we wanted to have like let's say qualified custodian in let's say the best sense that it's possible in the crypto space.
But I mean, Coinbase has Bitcoin Cash at least, right? I don't know about
Sure, yeah. But so one of the minority forks, for example, is what's excluded. So that excludes Bitcoin Cash and BSV, for example.
Yeah, I know. I mean, that's what I'm trying to understand, right? So why do you exclude? I mean, BSV, you know, it's not that liquid, right? Also, like, so I'm on your side on the BSV side, but on the Bitcoin Cash side, obviously they have the higher transaction volume because they can take more data into each block, right? So it has obvious extensions and advantages, right? To
sure,
Bitcoin.
yeah. I mean, for us, it's just we decided to not include minority forks.
So you're just going to go with the biggest one. So like Litecoin, would that be a fork of Bitcoin as well? Or?
No, because I mean, it's based on the same code base, but it's not like a fork of the UTXO set.
Interesting. You're picking your battles. Okay. Cool. Okay. I mean that.
And yeah, other than that, I mean, there's no cap or anything.
Yeah, because
it just tracks the asset.
I think this is really, really weird. Let me know what you think about it. So I just pulled in the BCGI, so Bloomberg Galaxy Crypto Index, and obviously this is pretty famous, right? And what I see here is 30% Bitcoin, 30% Ether, and then 20% Ripple. And obviously, if I look at, so that obviously is not market cap weighted, right? So because if I look at the coin market cap weighting, right? So we have 174 billion in Bitcoin versus 26 billion in Ethereum.
Well, maybe if the cap the maximum size, then
but that would not get you to Ethereum 30%, right? Either way, like Ethereum, that is, what do you want to call it? Like total market cap is right now 269.26, so it's exactly, almost exactly 10%, right? So Ethereum should be like 10%. Bitcoin obviously is something like 70, and then Ripple 20%. So what do you think about this kind of weighting?
So I'm not familiar with like the criteria on like how they get to that weighting. My assumption is that they try to kind of cap the Bitcoin exposure. We see it with our index. Like obviously, yes, we have Bitcoin is by far the biggest, right? And then we have, I think, 12% Ether more or less at the moment. So I think like they might want to kind of force a little bit more diversification into the index.
Okay. Yeah, cool. Let's move on to the active trading stuff that you guys are working on. I think that's pretty interesting for the group here that's participating. So you mentioned you are trading spot versus futures, right? And trying to
arbitrage. Spot, derivatives.
So how does that work? Walk us through like these trades, right? Did you, what kind of analysis did you put into that? What kind of infrastructure have you built up for that, kind of to make that work? Is that how's that hosted? And maybe give us some details on that.
So in terms of hosted, it's as like closely co-located as possible most of the time. A lot of the exchanges still run on the cloud. Not all of them offer co-location. In terms of the infrastructure we built, it's really like from scratch. So we built an abstraction layer essentially that allows us to essentially merge all the different APIs from the different exchanges and trading venues into like a single interface. I think still today that's one of the biggest challenges, is that you go to exchange A and they give you an API. You go to exchange B, new API, new data model, new everything, new features. Exactly. So it becomes very cumbersome to kind of do that integration work. So what we spent better half of 2019 doing is really building this abstraction layer so we can actually build our strategies, our execution against like a single interface, rather than having to worry about changing all the actually trading part of the service over and over again. This also allows us to now be much more flexible with the integration work. So you can have one team working on integrating new exchanges against that interface, and you can have a second team working on execution strategies and so on, without having to worry about what's happening on the integration side, because they built against this single interface.
So why didn't you use like one of the other interfaces that are around?
There is none.
Well, there is, for example, Coinigy. Do you know those guys?
But these are all proxies, right? So if you run like latency sensitive systems, like you're just adding like an additional hop, you have to trust them with your API keys. Like there are like a lot of downsides essentially to using these kind of like middleman services, right? Then obviously it depends on who you are, what kind of strategies you run, what are you trying to achieve, right? But for us, it's really about like how do we build like high performance systems that are also secure in a way that we feel confident with, right? Because a lot of people worry about private keys and what if people steal my coins. At the same time, like the exchange keys, if you have like trading access, can be almost as dangerous, right? They for whatever reason, right? Like even Coinigy itself can get hacked, right? I'm not saying Coinigy or whatever other service necessarily nefarious, but they can lose access to their database, or somebody can get in there and potentially like execute bad trades, things like that, right?
Yeah, for sure. But I mean, at the end of the day, right? I mean, I think what the advantage of crypto was always, like you can stack, right? And I'm not saying like CoinEng or any of the other interfaces is like the solution, but I mean, it would at least be nice, like if the space evolves, right? And everybody
Absolutely.
can.
And I mean, there was one where actually James, who's our principal engineer, worked on. I think it was called Exchange, which is a Java library that does exactly the same thing. But yeah, we just weren't happy with the quality and the way it had been maintained. It was very bloated by the time we got there. And yeah, so we started from scratch. What we are going to do with it, we don't know yet. That there is obviously the option to potentially open source part of the library.
Yeah.
But it's not something we kind of want to kind of actively pursue right now, just because it would be a distraction. But yeah, I mean, that option exists. We agree, right? Like if you can have actually like a high quality library out there that allows you to do that, we think that it would have a lot of value. We just didn't find anything that like satisfied our needs. That's why we kind of started doing that. And then a lot of the other services that are out there are more focused on, say, the execution side of things. So smart order routing, algorithmic kind of execution, TWAPs, VWAPs, stuff like that, which is really not kind of what we're focusing on. Our systems are more geared towards arbitrage and like actually implementing our strategies.
Yeah. So walk me through like, okay, so what, like, give me an example of like the arbitrage that you guys are looking at. So
I mean, from a strategy perspective, it's very easy, right? Like, there's two prices, one is lower than the other. Like there's not like our risk, like from a strategy perspective, it's very simple, right? So there's not a lot of like quantitative modeling that's going on.
Yeah.
It's really just buy low, sell high.
And so you're arbitraging major markets or like smaller altcoin markets?
Right now we're focusing on Bitcoin and Ethereum. Not really focusing on any of the smaller ones.
And this is inter-exchange arbitrage or just spot versus
cross market, cross product, and then the cash and carry basis trades across.
So what?
Spot and derivatives.
Okay, so spot and derivatives versus and then across different exchanges. And like, what's your estimate on performance on that? Like you said, you are trading this now for a while. Like, what is your kind of target return on this?
I mean, I'm not sure from a regulatory perspective how open we can talk about returns.
Then you can say an expectation, right?
Yeah, I mean, we would expect above 10%.
Per what? Per year?
Against Bitcoin or US dollars.
Ah, okay. And but that's per year, you mean?
Yes.
Okay, interesting. What do you think about, because I had a discussion with Godfrey here earlier this week, and he's also on the call, and we talked about stable coins, and I was like, yeah, but stable coins, that sounds weird. Why would there be a lot of arbitrage? But then, of course, there is the DAI system, right? And the DAI system is extremely volatile, obviously, because it's not a full hedged and it's not backed by US dollar. So I actually just checked out, what if you do a very simple strategy, and the strategy goes like this: DAI below $1, you buy DAI above $1, you sell, right? And guess what? Like, have you looked at that?
No, I mean, we do some trading on the stable coins, but it's not like our primary focus right now.
I'll show you the back test. Or again, yeah, just the and well, so let me know what you think, right? So basically, I pulled in just the prices of the multi-collateral DAI. Yeah, so it's kind of, you see it's fluctuating 99 cents. It's sometimes 2 cents above. A lot of times it's just $1. And I just pulled it, since the DAI is live. So DAI is obviously an upgrade from the SAI, from the single, whatever it was called, DAI asset. and this is only live since November, but it doesn't matter, right? The point is, okay, so the system goes like this. If it's so I actually calculated, okay, what is there an average, right? Because funny enough, DAI is trading slightly above $1, which I actually, well, I mean, first of all, what do you think about it? Like, why do you think DAI is trading on average above $1?
I mean, I don't have like enough insight into DAI specifically. I mean, at the end of the day, the reason is because there are probably more buyers than sellers.
Yeah, but why?
It can be probably, I mean, typically I would assume with something like DAI, it's just maybe hard to get your hands on. Like, I'm not even sure what are all the different markets where it actually trades.
Well, I think there's a very simple explanation, but we have, and my explanation would be, you're getting a very good interest on DAI, right? Let's check the interest rates. Let's go to compound or something, right? Compound. So right now, okay, I have like whatever $50,000 here. I'm earning 8%, but this was a lot higher, obviously. Or it's fluctuating.
1%?
Huh?
What's that one?
The 0.1 here.
Yeah, but I mean, like that doesn't necessarily explain it, right? Like you can do more on USD or.
Well, right now with USD coin, obviously it's trading high. Like you get 4. Oh no, you have to pay that. Wait, where is that supply?
But I mean, this is like decentralized. Like if you go to BlockFi or something, they're gonna pay you 8% on.
Exactly, but my argument is DAI is more valuable than US dollar, right? Because I'm getting interest on it, right? If I have DAI, that's beautiful,
yeah,
right?
I mean, but I mean, USDC technically is dollar as well, right? You can like lend your USD fiat as well. Like, I'm not sure like to what extent. Maybe because it's quote unquote permissionless, but I'm not sure if that actually warrants like a premium.
I would say why not, right? I mean, I would be interested to have DAI rather than, let's say, US. I mean, first of all, US dollar, right? US dollar right now, T-bills are at 0%. So obviously I have an asset, and you're right for USDC, but probably for USDC, the market is just way more efficient, right?
Well, no, I mean, I would probably do it like account it more to the fact of like the market is just very inefficient, right? Like if I look at the volumes, like it's DAI USD is 15 million. Like it's just tiny, right?
Exactly. Well, yeah, for sure. I mean, okay, so it's probably a combination of it's tiny, it's a liquid, and it's a niche. But like at the same time, so the volatility on DAI, right? So although this is supposed to be a stable coin, calculate the volatility here. Freddie, you have a question. You're jumping in with a comment here. You want to just
Yeah, no, I wasn't sure if I might have to hop off before the end, but yeah, I was just going to speak to the DAI example. Yeah, you're right. I think there are opportunities beyond kind of the traditional, block, like you stick your USDC and USDT into BlockFi and earn a lovely 8%, but when will they run out of VC money? And then there's obviously the DAI angle, which is still kind of a bit experimental, the soft peg around 1. One of the hard things for DAI is, well, in part, its market cap is particularly low. The fact that its market cap is low, relative to a USDC, and it's kind of more difficult for it to expand. Mm-hmm. And so actually market makers struggle to close the arb back to $1. So that's why you see like often quite dislocations around $1. Your kind of mean reversion strategy around the $1 is obviously fantastic if you completely ignore the credit risk of DAI just completely depegging. But obviously don't give free alpha to everyone. I mean, but
yeah, and we'll talk in the webinar with you, right? We'll talk about like the March incident when
absolutely.
this was actually quite close, right, to decoupling.
But really, we should have all been what we should have all been doing is buying MKR because it's probably I think it's up 400% since then.
Yeah, they did pretty well since then.
Anyway, I just wanted to reiterate your point about the interest rates on DAI and the yield opportunities. Because it is quite inefficient, yes, it is. There are some good strategies to be had around it as long as you're conscious of the risks and the limitations of closing any arbitrage you might want to do.
Yeah. Just to wrap up this example here. So like there seems to be kind of there seems to be like an offset of the $1, but doesn't matter. So simple strategy, right? And I just buy if it's below this $1 and 44 basis points, and I just sell if it's above, right? And just to show you like this example, right? It's an amazing strategy, yeah.
But I think like what gets often kind of overlooked in the space, right, is that on the surface level there's like a lot of opportunities, but then when it actually comes to like implementation, execution, and also then especially scaling it, it becomes very, very challenging, right?
Absolutely. Yeah, I looked at DYDX to implement this because first I looked at Coinbase, but then I found out, there is a nice premium in Coinbase. It's trading at 35 cents or 37 cents above the dollar. I was like, whoa, this is 35 cents free lunch, right? But then I figured, Coinbase is taking a 35 basis point fee on it. And it doesn't matter how much I trade, even if I put in $1 million in, they're still going to charge me 35 basis points. So I was like, okay, that's clear. Okay, that's not going to help me.
Yeah, and I mean, we saw, I think it was early 2019, when there was like a 2-3% premium on Bitfinex, for example. And that was based because they had like limitations. I think above $1 million, you had to pay like a 2% withdrawal fee. So you were capped like in how much you could actually exploit that opportunity, right?
Yeah.
So yeah, I think like that's something that's like on the surface, there's a lot of opportunities, but then if you actually dig into it and say, okay, how do we actually now turn that like into a viable strategy, then there might be infrastructure problem, like from an operational side or from the volume side, like with $15 million in volume, like we're just not going to be able to turn that much money around, right? And at some point, the question also becomes, okay, like, is it worth the overhead for actually like the amount of money that we can put to work?
Yeah.
And I mean, that's why we, for now, are focusing more on like centralized exchanges and things like that, and less on the decentralized side, just because it's still like immature in terms of like yes, we understand that there's a lot of opportunity in terms of spreads and like tons of inefficiencies left and right. But from a business perspective is, okay, how do we then turn that into a business, right, where we can not just trade $2-3 million without necessarily starting to impact the market.
Yeah, cool. I mean, before we wrap up and open it up like to some other questions from the other people, I just want to find out, like, again, coming back to the question, like, where do you think Bitcoin is going, and like, where do you have your crypto right now? Like, in what do you have it in the market? Are you in cash? Are you are you all into your market strategies? Are you all in just holding Bitcoin? Like, what's your position? Like, what's your own book? Just
I mean, personally, yes, long Bitcoin. I don't think that's going to change anytime soon. So yeah, I mean, it's primarily just putting it to work and turning it ideally into more Bitcoin.
Yeah,
that's kind of the mindset. And yeah, in terms of, I mean, similar to what we're doing with the active strategies, right? It's essentially creating a portfolio of different strategies where we can essentially generate absolute returns regardless of the direction of the market. And then it's up to the individual investor to decide, okay, I actually want to be market neutral against USD, or we have people we work with, like myself, example as well, it's like, okay, I would rather be long Bitcoin and generate a yield against my Bitcoin, right? So I'm not looking at it, the price of Bitcoin in USD. I'm looking at, do I have more Bitcoin at the end of the month? Yes or no? In terms of what Bitcoin is going to do, I mean, short term, I think it's more or less irrelevant in the sense of impossible to predict. I mean, whether it's like some of these moves that are likely driven by leverage trading, like we saw at the beginning of the month, or I mean, even what you mentioned before back in March, obviously at a higher degree, but I think these are like moves that are primarily driven by leverage trading, where just people being overexposed with too much leverage. And then it moves, goes both ways, right? Medium term or long term, I think we are seeing a lot of, let's say, positive signs at the end of the day, whether that's data coming out of the exchanges from like new account sign-ups, new account creations, more volume, things like that. Same for open interest and like on futures and options. You have people like Paul Tudor Jones coming into the space, kind of making some noise, removing some of the, I would say, career risk maybe for other managers and other more, let's say, professional investors who might still be afraid that they don't want to be the guy that bought Bitcoin and it crashed essentially. And then, yeah, obviously then what adds to it is the whole like central bank and governments around the world trying to do everything they can to kind of support the economy and kind of bridge that gap caused by COVID. And now you have social unrest in the US. Like, I think like from a macro perspective, there's a lot of things that in theory should have a positive impact on an asset like Bitcoin, right? If the underlying theory is correct in the sense of we have a asset that it's portable, it's liquid in the sense it's the only thing trading, maybe besides FX, trading 24/7. It has like, it's the only thing that's like limited in supply. It's like a predictable supply curve. Yeah, I think, I mean, for us, I mean, again, like going back to the point, right? Like long Bitcoin, we think long term it's gonna increase in value because of some of the external factors, because there is a whole community working on educating people, onboarding people into the space. So at the end of the day, that's what's gonna drive the price, right? It's like, how much net new money essentially can we drive into the space?
Yeah, it's like right now, the Grayscale Bitcoin Trust, obviously, right in the US, is buying more, has more inflows than there are actually being Bitcoins mined by the Bitcoin mining.
Yeah, I mean, I still need to go through the article published by Messari yesterday. I'm actually not entirely sure that's true. I think that might be based on the numbers, based on actually the OTC market, which is trading. I'm not sure what the premium is on the Bitcoin right now. On Ethereum, for example, it was like 700% recently.
Yeah, on Bitcoin it's like 50. Yeah.
So there's still like a lot of uncertain or misunderstanding, I guess, in the market in terms of how this product actually works. And mainly from like a retail perspective, essentially. So yeah, I mean, we're looking forward. I think like end of the summer, we should have like the next release, essentially, where new shares become liquid. It's going to be interesting to see what happens to the premium there. And
in the Bitcoin Trust.
Yeah, Bitcoin and so Bitcoin now, GBTC now has like 6 months lockup period. The others have a 12-month lockup period.
Exactly.
That really goes into the mechanics of how this product works. So you have essentially a limited number of shares.
Yeah.
And then after 6, respectively 12 months, they become actually tradable OTC.
Yeah.
And
well, then you place them in the secondary market, right? So then you can just sell them, obviously, after the lockup. Yeah.
Yeah. So I mean that
should obviously drive down the premium, and especially Ethereum. We looked at it as well, and we're also just looking at if that's an interesting trade, because obviously a 700% premium on the Ether.
It's free money.
Yeah, it's good money. So yeah. Anyway, so okay, cool. So let me stop here from my side. I just wanted to open it up for somebody else to ask some questions here about to Fabio, like about market making or passive strategies, or his whole setup that he built here in Switzerland.
Hi, I have a quick one that is, so first, thanks a lot. It's very interesting. On the counterparty risk, when you do any kind of market making, lending, etc., how do you track counterparty risk, and especially how do you decide whether or not to basically include a new counterparty or exclude a counterparty based on the info?
I mean, in terms of the monitoring, it's just I would say like a diversification across multiple counterparties and like limiting the maximum exposure essentially towards the individual counterparty. In terms of the due diligence, I mean, we just tend to work with more established exchanges that have been around for a certain number of years, that have had say no incidents, and that, or if they had incidents, they kind of behaved in the appropriate way. If you think I don't know, somebody Bitstamp, for example, when they had how is the disclosure policy, how transparent are they, how do they what happens afterwards, right? Do they just say disappear or don't say anything, or do they actually communicate transparently and then kind of make the clients whole again? How does that work? But yeah, obviously, I think that's still one of the big question marks, right? Because obviously there's no free lunch. So we actually believe that there's going to be an interesting tension and opportunity as well between kind of these two streams that we are observing right now, right? So you have the CME and maybe someone like Backed or something, the more regulated, traditional, established kind of companies coming to the market. And then on the other side, you have Deribit and BitMEX, the less or non-regulated markets. And yeah, we think that there's potential opportunities in the discrepancies that are going to emerge there as well. And it's just, through limiting the exposure to individual counterparty, essentially a higher risk depending on how long have they been around, what jurisdiction are they in, how transparent are they in terms of the people also involved. Doing as much due diligence as possible. I think some exchanges are more open and you can build, say, more personal relationship with. Others are, let's say, more distant, and then that's would have a negative impact on a score, right? I mean, just want to avoid the quadrigas, I guess, of the world. I think the fact that we're also not focusing that much on, let's say, the long tail of crypto assets doesn't force us necessarily to go to, let's say, more exotic exchanges. So yeah, we're really trying to kind of work with the established brands in the space.
Cool.
Okay.
Yeah.
Thank you.
It's a tough one. It's a tough one, I guess.
I think it's still one of the bigger challenges, right? When it comes to risk management, it's like.
Yeah. Cool. Yeah. Any other questions from the group?
I've got one more if there's a bit of space. Yeah, it was actually more related to your the previous company that you exited. I was wondering, did you just indexing Bitcoin at the time?
Yes.
Cool. I guess I kind of had two questions then. I guess the first one would be, do you wish when you'd set up your company it mapped and indexed Ethereum given the richer data available on that chain? And the second question would be, now that you've exited and are championing Base58, what blockchain analytics companies do you use today, and what do you use them for?
So the first question, I mean, like it was already hard enough to kind of find people interested in the data on the Bitcoin side back in like 2014. I mean, Ethereum wasn't even really around when we launched, right? So it wasn't even an option. And yeah, by the time, like, it was never like, it was obviously on the, let's say, the long-term roadmap, right? To start including it, but we never got to that point essentially. Yes, I think there's interesting opportunities. Obviously, you have like more data, more flexibility. I think for us, it was just, I don't know, you're a small company, there's only so much you can do. To the second question, I mean, the companies today, I mean, there's Chainalysis, Elliptic, CipherTrace. Like for us right now, the purpose for using these companies is really just to kind of comply with regulation. To some extent, we outsource that to kind of to our partners on the onboarding side, right? I would assume, given the context of this conversation, you might be driving at like quant-driven strategies based on blockchain data.
Well, yeah, I'm just interested. I mean, obviously, exploring strategies across the space. I think plenty of people have given it a go. It's whether there's anything to be actually found there.
I mean, it's hard to say. At the end of the day, the exchange flows, like the miner flows, unless you actually go implement it and like back test it properly, I think it's very hard to say if there's any like predictive value in that, right? I think like in hindsight, it's always going to be very easy to kind of connect the dots. Whether you're actually going to be able to derive any sort of predictive value from the data, I think it's a bigger question. And then the other important piece is, to what extent do you want to rely on that, right? I think some people that have been running more quant-driven strategy on this kind of data, from like the anecdotes that I'm hearing in the market, have then also got hit really bad as soon as the market turns, right? I think it can be an important component, but I think it's also important to not look at it like in isolation, because again, like it's transparent, right? So depending on how many moves ahead you want to think, I can then also start playing with the data, right? So as soon as it becomes known that somebody's looking at exchange inflows, okay, like if I want to play that, I'm just going to start sending tokens to an exchange and kind of pretend that there's more inflows, right?
Yeah.
So I think it's a tricky one, but yeah, obviously it's fascinating, right? I just think the reason why we're currently focusing more on the arbitrage, and these are just safer strategies for us, in the sense of we know if we implement them and if we execute well, we can make money. With a lot of the quant and especially like the blockchain driven stuff, I mean, that's more like a research field, right? And you need to have like the resources available to actually say, okay, we're going to work on this for a year, and maybe we don't find anything.
Yeah, Freddie, I'll give you a trade if Fabio doesn't want to give you a trade. So because so I'll show you this. I showed this last week as well. I don't know if you saw that. I don't think
I couldn't join last week, I'm afraid.
Yeah. So I'll show you this. I'll show you this again. I don't know if Fabio saw it. I didn't see it either. So I'll show you this. So basically, and we had a great conversation last week about, is hash rate driving the Bitcoin price, right? And our favorite trade in the last year, and it comes back to what Fabio said, right? We worked on this trade probably over a year, and we just got lucky essentially because we got hired by a mining firm, right, to kind of figure this out. And a mining firm hired us to kind of help with the treasury and then also kind of hedge out the mining risks, right? And that is hash rate, also difficulty level, and Bitcoin price. And so what we did is we sold OTC swaps against future difficulty, right? Why? Because that basically then locks in the production over a certain time period, right? And at the same time, you can sell the Bitcoin future, right? And then you can lock in the production and you can lock in the Bitcoin price. And then, of course, you know how much money you're going to make, right? And that is more than what you pay for the machines. Then, of course, you're happy, no? And and now, funny enough, a couple of weeks ago, FTX started. They launched a hash rate future, and this was extremely exciting for us, I have to say. Because, because we ran about $1 million of production per month, and we had like basically just this crazy OTC market trading with some guys in New York and some in Singapore, and always counterparty risk was always an issue, right? And now this happened, and what and our main assumption in this whole endeavor was, if so difficulty today is going to go up 6% per month. That's one thing. Why 6%? Because 6% is the doubling of hash rate over 1 year, and that would be Moore's law, right? So that's our base. That was our baseline. And the second big assumption we had was if Bitcoin price goes up, hash rate goes up as well with the same amount. Right? That was the second biggest assumption, and so they should be in sync. Yeah, this future hash rate or difficulty and the Bitcoin price. And now check this out. Yeah, so check this out here on FTX, and I plotted here the hash rate live future Q3 versus the Bitcoin perpetual future. And can you see this? So basically, so I'm gonna, here we had this Bitcoin gapped up to 10,000. And then drop back down and see what the hash rate did. The hash rate didn't move, right? Then the two were moving around to each other. Bitcoin moved up again to 9.6 or something, back down to the hash rate. And now, yesterday, of course, Bitcoin dropped to 9,200, and see what's happening now again, right? It's coming back here. So I think this is extremely interesting because what this means is you can lock in about 3.5% to 4% per month in selling the hash rate, right? Because why is that? Because the hash rate, if I take this off, it's trading at 7,100, 17.1. And if you check out what's the current difficulty level, it is obviously at 13.7. Yeah. So if you say now it's 17.1 divided by 13.7, so you're getting a 25% premium, right, on hash rate right now. So you deduct, and there's 24, and then you take off the 2. This is for 2 months basically now left, minus the 2 times 6%. So you're getting a 11% premium for 2 months. I think that's quite interesting.
Yeah, that's really interesting. I'll have a look into it, especially on the basis of Moore's law continuing, because I'm not sure that assumption. I don't know how long that will hold, but or if even
I've had so many discussions with these mining guys. You cannot imagine about it, because they are always like, no, this cannot happen, impossible, right? I mean, this is what's just too hard, difficulty. Well, no, it's not too hard. I'm really, really sorry, right? I mean, just look at the difficulty, right? And this is logarithmic scale. This is just normal linear scale, and you can see it never goes down, and it doesn't even go up 6. So on average, it didn't go 6% per month. This would be 100% per year. It went, in fact, up 400% per year. That's the average. So 400 is kind of the average, but that the main driver of that was because Bitcoin rallied. So if you take out the Bitcoin rally, then it exactly comes down to a 1-to-1 relationship. Like I think it's a 0.97 correlation to Bitcoin price, and 100% doubling every year basis. So it's really interesting. Yeah. I mean, we can talk about it in or I can send you some data on it.
Yeah, sounds cool.
Cool. Well, it's already 12 o'clock. Any more urgent questions for Fabio, or shall we close it here?
I mean, otherwise, yeah, you can reach me email or Twitter or whatever.
Fantastic. Yeah, I'll everybody. Yeah, if you're not connected to Fabio, just reach out to me. I'm happy to introduce you. And so let's close here. Thanks very much for joining, Fabio. But thanks very much for joining, everybody, and then see you again next week.